Welcome, welcome, welcome to Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland.
And I'm Mike Alexander.
Well, thank you all for joining us. You know, in 2023, there was one show in town. It was a one-trick pony, and it was none other than the Magnificent
Seven.
That was the only show in town. Magnificent Seven in 2023 returned over 70%. The ho-hum 493, in other words, the remaining 493 companies in the S&P 500 only returned 5% for the year. What's interesting is that if we were looking at the end of November last year, the ho-hum 493 were actually negative year to date. The question, Mike, you being the CIO here at Concenture, is what's the story with Magnificent Seven? Is that horse the only horse that we should be betting on in this race? I know the answer, but what do you say?
So I'm going to tell you that the short answer is no. But with that being said, most trends that exist in the marketplace can go further than you thought they would have, should have, or could have. And so, as we start 2024, it was it's been a whole lot of the same level of leadership. And look, I'm not here to tell you that there's not reason for there to be tremendous excitement about AI and its impact on some of these companies. But if we're to believe that that a lot of that excitement is legitimate, then eventually that's going to impact other businesses as well. And so while returns have been phenomenal in that particular spot of the marketplace,
right,
and the rich have really gotten richer, eventually, for it to be healthy for markets, I think we need to see some broadening of that.
Well, let's back up. Let's talk about exactly what the Magnificent Seven is and how it came to be. Can you give us a little bit of background on that?
Yeah. So if you go back, several years ago, a lot of investors and our listeners will remember, kind of the FANG stocks, right? It was at that point, it was like Facebook, Apple, Amazon, Netflix, and Google, and then eventually kind of Netflix kind of left the playing field, if you will, because it fell out of favor. You can make the case that it's back again, given their earnings for the fourth quarter, and the stock rallied about 10 or 15% in a single day. And so the names have changed a little bit across the board, but as we kind of moved forward, and some of the bigger tech names and the AI names kind of came into the fray, if you will. NVIDIA was added in there. Obviously, Facebook is no longer Facebook. It's really, it's Meta now. And so, we've seen some of the names change, but it's really just these ultra mega cap names, typically companies that have a market capitalization that is either above $1 trillion or at least nearing $1 trillion.
So those companies would be Microsoft, Apple, Amazon, Meta, Google, NVIDIA, and Tesla.
Yes.
That's the seven. The markets view them as the only show in town. That's the only place to be. What's interesting is I heard these statistics through the third quarter of last year. If you looked at earnings growth and compared it against an industrial bellwether, Caterpillar. Caterpillar beat Microsoft and Amazon 9 out of the 10 prior quarters in earning growth. But Caterpillar had a good year, but I wouldn't call it's not near $1 trillion of market cap, and it didn't have a 70% return. It beat Apple 8 and Meta 8 out of the last 10 quarters. It beat NVIDIA 6 out of the last 10 quarters. The only company, now this is as of October 2023, the only company that remotely kind of came close to beating it was Tesla. And then this year we've kind of realized that their earnings growth maybe isn't as much as what is expected. But the markets are telling us the only show in town is AI and technology, and that's where you have to be loaded. Clearly, you need to have it. But isn't that skewing the returns of the S&P 500?
For sure. Obviously, it's taking up, you mentioned the numbers at the outset where you have one part of the marketplace and it happens to be the largest market cap companies up 70% when the rest of the market is only up 5%.
Yeah, but hold on. So walk through how the S&P 500 is set up and how these companies would have a larger impact there.
Yeah, so a lot of the way that the way that most of the indices work is that they are market cap weighted. So the larger the market capitalization of the company, the larger weighting it actually has within the index, if you will. So a company like Apple can be, given its market cap, can be 7 to 8% of the S&P 500. The same thing exists with Microsoft as of today. Obviously, you've got Apple and Microsoft both sitting over $3 trillion in market cap. Here's what I think, Robert, makes it really difficult if you're managing, a portfolio, is that technology right now makes up about 30% of the S&P 500. Now,
wow,
clearly when things are going really, really well, having 30% of your money in technology, feels really, really good. But I think it's really, really hard also for somebody to try to run a diversified, risk managed approach and have 30% of their assets in a single asset class that's tied to something like AI. Now, for those of us that have been around for a while, and you and I are included in that group.
I'm not. I'm young.
And you're young. That's right. I'm not included in that group, but we can remember, kind of the tech bubble where, companies were getting measured on clicks and subscribers,
right. Website hits. Yeah.
Yeah. And things of that nature. And so some of these companies have pretty enormous multiples, pretty enormous valuations. Now, with that being said, when you're in an environment where, earnings growth is slowing, for example, companies that have the ability to grow tend to trade at higher multiples. And that's kind of been in the environment that we've been in. But as you and I both know, trees don't grow to the sky. And there is a point where, it just becomes unhealthy for markets. We saw this in the 1970s with the Nifty 50. We certainly saw it during the tech bubble. And perhaps we're seeing a little bit of that now. I'm not saying that those companies can't continue to move higher, but I think some broadening of the marketplace would be healthy.
Yeah. And, we kind of the last 8 weeks or so, we've seen a little bit of that because at the end of November, that 493, they were actually negative. They ended the year up over 5%. That was a good move. The diversification is a key, especially if we're going to enter in a time of volatility. The thing to me that is amazing is that the markets are basically saying the only place that there's earnings growth are in these 7 companies. And that's just simply not true, not the case when you go and look at companies like Caterpillar that have beat these companies consistently on earnings growth. And so as we're going and we're looking at kind of how much longer, there's a certain extent of ride them while they're going, right? Ride that horse while it's running. But when it tires out, you got to make sure that you're ready to get out. Talk a little bit about how because the S&P 500, like you said, 30% of the market is tech, or S&P 500 is technology. How should you look to diversify with the Magnificent Seven?
Yeah. So look, I have no problem with the ownership of some of those. One thing that I think, any investor would want to bear in mind is that if you're doing really well as a company, there is, inevitably you're going to see some competition that enters into the marketplace. Now, sometimes the barriers to entry are kind of difficult, but one of the things that we noticed, Tesla being a good example, is that now the number one seller of electronic vehicles or electric vehicles is actually BYD out of China, which recently surpassed Tesla. So you're going to enter a period where you're going to see some competition. And so I think the way that an investor should think about it is, keep in mind that some of these companies don't really return much money back to shareholders. So if you're actually looking to generate an income from your portfolio, being able to diversify away from some of those larger names to companies that, have paid solid dividends over the years, they're not going away. And if we are to believe that, that all of this strength is in all of the benefits are, from AI, as an example, it results in all of the sales. Well, they're selling it to somebody, and somebody's actually out. Some other companies out there actually buying it, and they're buying it to enhance productivity. So eventually, that should flow to the bottom line.
Yeah, I think the key point is I think people need to review their portfolios to understand we love technology for 2024. You just can't not have technology, and these names seem to be pretty well-run companies. I mean, we could argue or debate about this last quarter or whatever with different people or where things are, but for the most part, these are very well-run companies, and they do make a lot of money. They may be a little bit overvalued here, and one of the things that I think is really interesting is if you go look at the earnings per share, the price to earnings ratio, right? That's a way to value companies. We can go back and we can look on rolling 10-year periods, and people talk about this market. Is it overvalued? Well, I argue that the market is not overvalued, but these Magnificent Seven may actually be close to or they may be overvalued. And that's where that diversification comes in. Technology is clearly making a big impact. It drops straight down to the bottom line with like what you said, with productivity. We can't go away. Could you imagine going 2 weeks, although I would probably love it, go 2 weeks without your cell phone? Probably not going to happen. I know there's a lot of people who would go absolutely crazy, but these companies are still good companies. But the reality is that they probably still have a little bit more to go, but it's not going to the sky. And there are other opportunities. When you go and you look at dividend paying stocks, when you look at some of those other companies, I think that's where people have to pay attention. Any kind of thoughts on that?
I think you're 100% right. I think there's always opportunities in areas that maybe aren't getting quite the attention that they should. I'm not telling you that these companies shouldn't be getting the attention that they're getting, and I'm not here to tell you that they won't continue to move higher. But I think this whole idea from a diversification standpoint of having 30% of your assets in one sector is probably a bit more volatility, a bit more risk than most investors could actually take. So, the reality is that there are plenty of good ideas out there. One thing I think that bears mention is, we've talked about this in previous podcasts. There's about $5.5 trillion that's been sitting around in cash, and that money eventually is going to be flowing somewhere. My guess is it doesn't flow 30% into technology, and that it actually recognizes that there are other opportunities out in the marketplace. And so I think there are plenty of things out there to buy beyond the Magnificent Seven or the Big Six or Super Six or whatever you want to call it. And I think those are certainly areas that I think investors want to be looking at.
What's funny is I'm reminded back to a long time ago, and I'm going to get some of these back in the early 90s. Forbes magazine used to do a once a year talk about mutual funds. And it started off in year one, the 10 mutual funds that you want to own. Then the next year, it went to the 8 mutual funds that you want to own. And something like 3 of the 10 were in the 8. And then the next year it shrunk, but none of those were in the 8, and one of them was in the 10. And then they finally got to their last year that they did this, and they did the one fund that you must own. And it had never been mentioned before. My point on that is where that money is flowing creates a lot of risk that's inside there. I think back to 1999 when we were in the tech bubble. I was sitting down doing a review with a potential client, and I noticed that his portfolio had nothing but .com stocks. That's all it was. And I told him, I said, hey, look, there's risk. He goes, oh, these are all blue chips. Well, they were the Yahoos, those type companies that had been rocking. They weren't for what the future is. These companies are still around and still good companies. Still, the Magnificent Seven or the Super Six are still good companies. But what would save people is making sure they understand what's inside of there, because it's not the only show in town. And if at some point they come out of favor, and generally, as a professor told me in college, he said that when your barber's telling you about a stock, it's time to sell. When the only stocks that they talk about on CNBC or on some of these other publications are the Magnificent Seven, it might be the time to reevaluate where your portfolio is.
I think that makes perfect sense and very good advice.
And with that, we want to say thank you for joining us on Wealth Strategies Unleashed, Magnificent Seven. Woo! Make sure you're evaluating your portfolio and you know where it is. We will see you next week.
See you then.